I need to tell you something that I have never said publicly before in over 4 decades of managing money through crashes and crises in every kind of market environment imaginable. I have never been more concerned than I am right now. This is the most dangerous market I have ever seen. And I do not say that lightly. I was there in 1987 when the market fell 22% in a single day. I watched fortunes evaporate in hours. I saw traders who had been wealthy in the morning become bankrupt by the afternoon. The panic in that room, the screaming, the disbelief. I can still feel it when I close my eyes. I navigated the dot-com collapse when trillions of dollars evaporated. I watched companies that had been valued at billions become worthless overnight. I saw an entire generation of investors who thought they were geniuses discover they had just been lucky in a rising market. I saw the 2008 financial crisis unfold in real time and made money while the world burned. I watched Lehman Brothers collapse. I watched the Fed scrambling to prevent a complete meltdown of the global financial system. I watched the stock market cut in half while unemployment soared and families lost their homes. I have seen dangerous markets. I know what danger looks like. I have the scars to prove it. But what I am seeing today is different. It is more insidious, more structural, more difficult to escape. And the vast majority of investors have no idea what is coming. They are sleepwalking toward a cliff, reassured by the calm before the storm, convinced that someone somehow will prevent the worst from happening. Let me take you back to a moment that fundamentally shaped how I think about risk and markets. It was the summer of 2008. I was watching the financial system unravel in slow motion. Bear Stearns had already failed. Lehman Brothers was teetering. The credit markets were freezing up. Everyone could see that something was wrong, but most people believed the authorities would figure it out. They believed the Fed would step in. They believed the government would not let the system collapse. I remember sitting in my office looking at the data and feeling a chill run down my spine, because I could see something that most people were missing. The leverage in the system was so extreme, the interconnection so complex, that there was no easy way out. The authorities were not going to be able to fix this with a rate cut or a bailout of a single institution. The rot had spread too far. I went massively short. I bet billions against the financial system. And when Lehman collapsed in September, when the panic finally arrived, those positions generated returns that most people would consider impossible. While the average investor lost 40% or more, I made money, significant money. But here is what haunts me about that experience. I was right about the crisis. I saw it coming. I positioned correctly, and yet even I underestimated how bad it would get. Even I was surprised by how close the entire financial system came to complete collapse. We were hours away from ATMs not working, hours away from the entire payment system freezing. The authorities managed to prevent total catastrophe, but it was much closer than most people realize. I tell you this story because I am seeing similar patterns today. Not identical. History never repeats exactly, but it rhymes. The specific vulnerabilities are different. The actors have changed, but the fundamental dynamic, a system that has accumulated so much risk, so much leverage, so much complacency, that a crisis is not just possible but probable. That dynamic is present again. And in some ways, it is worse than 2008. You see, in 2008, the leverage was concentrated primarily in the financial sector. It was banks and mortgage companies and investment firms that had taken on excessive risk. When they failed, the government could step in and bail them out. The government itself was not over-leveraged. The Federal Reserve had room to cut rates. There were policy tools available. Today, the leverage is everywhere. It is in the government itself. It is in corporations that have loaded up on debt. It is in households that have borrowed against inflated asset values. It is in pension funds that have made promises they cannot keep. And the policy tools that saved us in 2008 have been largely exhausted. Interest rates were at 5% before the 2008 crisis. The Fed could cut them to zero, providing massive stimulus. Today, after the most recent rate hikes, Rates are around 5% again, but the starting debt levels are massively higher. The Fed cannot cut rates as aggressively without risking a loss of confidence in the dollar. Quantitative easing was a novel tool in 2008. The Fed bought a few $1 trillion of bonds, and it seemed extraordinary. To date, the Fed's balance sheet has expanded to nearly $9 trillion. The marginal impact of additional QE is diminishing, and the risk of monetizing government debt, of triggering inflation expectations, is much higher. This is what I mean when I say the situation is worse than 2008. We used our ammunition, we spent our reserves, we accumulated debts, and now we face a new crisis with far fewer options. Let me explain exactly what I am seeing and why it terrifies me. The first danger I want to discuss is the unprecedented level of government debt and the fiscal trajectory we are on. I have talked about this before, but I need you to understand how serious this situation has become. The United States national debt is now over $34 trillion. That number has grown so large that people have become numb to it. Trillion does not mean anything to the human brain. So let me put it in terms you can understand. If you spent $1 every second, it would take you 32,000 years to spend $1 trillion. 32,000 years. And we are 34 trillion in debt. We are adding 2 trillion more every single year. The interest alone on this debt is now over $1 trillion annually. But here is what really concerns me. This is happening during what is supposedly a strong economy. Unemployment is low, GDP is growing, corporate profits are high. This is when we should be running surpluses, paying down debt, building reserves for the next recession. Instead, we are running the largest peacetime deficits in American history. What happens when the next recession comes? And it will come. Recessions always come. They are a natural part of the economic cycle. Since World War II, we have had a recession approximately every 6 to 8 years on average. The idea that we can avoid recessions forever is fantasy. When the next recession arrives, tax revenues will fall. They always do during recessions, because people lose jobs, businesses earn less profit, capital gains disappear. Meanwhile, spending on unemployment insurance and other safety net programs will rise. The deficit will explode from 2 trillion to 4 trillion or more, and we will be adding this to a debt load that is already unsustainable. But here is what makes this even more dangerous. During the last few recessions, we fought them with deficit spending and Federal Reserve intervention. We ran massive deficits. We cut rates to zero. We printed money through quantitative easing. These policies worked in the sense that they ended the recessions, but they created the debt burden we now face. They inflated asset prices to unsustainable levels. They encouraged excessive risk-taking. And now, when we need these tools again for the next recession, we face constraints that did not exist before. If we run $6 trillion deficits during the next recession, which is entirely possible, the debt-to-GDP ratio will spike dramatically at some point, and nobody knows exactly where that point is. Bond markets will lose confidence. They will demand much higher interest rates to hold us debt. Those higher rates will make the debt even more expensive to service. It becomes a doom loop. The Congressional Budget Office projects that the debt-to-GDP ratio will reach 160% within the next 20 years. 160%, that is higher than Greece when they had their crisis. That is higher than Italy. That is territory that historically leads to currency crises, sovereign debt defaults, or runaway inflation. Some people argue that the United States is different. We have the world's reserve currency. We can print our own money. We will never default because we can always pay our debts with freshly printed dollars. This is technically true, but deeply misleading. Yes, we can print dollars to pay our debts, but doing so destroys the value of those dollars. It is a default in real terms, even if not in nominal terms. Every holder of dollar-denominated assets, which includes most American savers and retirees, gets wiped out through inflation rather than through explicit default. The end result for citizens is the same. The market is not pricing any of this in. Treasury bonds trade as if the United States will always be able to service its debts, as if there is zero probability of a fiscal crisis. That complacency is itself a form of danger. When the market finally wakes up to these risks, the repricing will be violent. The second danger is what I call the everything bubble. Since 2008, central banks around the world have engaged in the largest monetary experiment in human history. They cut interest rates to zero and held them there for over a decade. They printed trillions of dollars through quantitative easing. They explicitly tried to push asset prices higher, believing that wealth effects would stimulate the economy. It worked in a sense. Asset prices went up. Stocks, bonds, real estate, private equity, venture capital, everything went up. Valuations reached levels that would have been considered absurd just 20 years ago. The S&P 500 trades at multiples that have only been seen at the peak of the dot-com bubble. Corporate bonds trade at spreads that imply almost no risk of default. Real estate prices have soared to the point where average families cannot afford homes in most major cities. But here is the problem. When you artificially suppress interest rates for over a decade, you distort the entire financial system. You encourage excessive risk-taking because the cost of that risk-taking is artificially cheap. You allow zombie companies that should have failed to survive on cheap debt, dragging down productivity and misallocating capital. You inflate asset bubbles across every category simultaneously. I have studied bubbles my entire career. I have seen the tulip mania of the 1600s in the history books. I lived through the Japanese bubble of the late 1980s. I watched the dot-com bubble inflate and burst. I saw the housing bubble form and collapse. Every bubble has its own characteristics, but they all share certain features. Excessive valuations justified by new era, thinking a belief that this time is different. Leverage that amplifies both the gains and the eventual losses. The everything bubble is not like previous bubbles that were concentrated in one sector. The dot-com bubble was primarily in technology stocks. You could hide in value stocks and bonds and real estate. The 2008 bubble was primarily in housing and mortgage securities. You could hide in treasuries and gold. Those bubbles were dangerous, but the damage was somewhat contained. This bubble is everywhere. It is in stocks trading at historically high multiples. It is in bonds that have been priced for a world of perpetually low inflation. It is in real estate that has become unaffordable for average families. It is in private markets where valuations have become completely detached from reality. It is in speculative assets like cryptocurrencies and meme stocks and non-fungible tokens. When this bubble deflates, and it will deflate, there will be nowhere to hide. The traditional diversification strategies will not work because everything is expensive. Stocks and bonds will fall together as they did in 2022. Real estate will fall. Private equity will face a reckoning as the marks catch up to reality. The losses will be widespread and severe. The third danger is the changing structure of the market itself. This is something that keeps me up at night because it is technical, and most people do not understand it. But it has the potential to turn a normal market decline into a catastrophic crash. Over the past 2 decades, the market has become dominated by passive investing, algorithmic trading, and complex derivative strategies. These changes have fundamentally altered how the market functions, especially during periods of stress. Passive investing through index funds and ETFs now represents the majority of stock market assets. When money flows into passive funds, they buy stocks regardless of valuation. They buy more of the stocks that have already gone up the most because those stocks have the largest weights in the index. This creates momentum that pushes prices higher and higher, disconnected from fundamentals, but the same dynamic works in reverse. When money flows out of passive funds, they sell stocks regardless of valuation. They sell more of the stocks that have already gone down the most. This can create cascading liquidations that feed on themselves. Algorithmic trading has made this even more dangerous. Most trading volume today comes from computers executing strategies in milliseconds. These algorithms react to price movements and to each other during periods of stress. They can amplify volatility dramatically. We have seen flash crashes where the market fell and recovered within minutes. But what happens when the algorithms all decide to sell at the same time and do not reverse? Then there are the complex derivative strategies, things like risk parity funds, volatility targeting strategies, and options-based hedging. These strategies automatically reduce exposure when volatility rises. When the market falls and volatility spikes, these strategies sell. That selling causes the market to fall further. Volatility rises more. They sell more. It becomes a self-reinforcing spiral. In 2018, we saw a preview of this when volatility spiked and several volatility-linked products collapsed. In March 2020, we saw another preview when the Fed had to intervene massively to prevent a complete market meltdown. Each time, the authorities were able to stabilize the situation, but each time, it took larger and larger interventions. What happens when the next crisis is too large for even the Fed to contain? What happens when the algorithmic selling and the derivative unwinds and the passive outflows all coincide with a genuine economic crisis? I do not know the answer, and that uncertainty is itself terrifying. The fourth danger is the geopolitical environment. We are entering a period of great power competition, unlike anything we have seen since the Cold War, and the financial implications of this competition are not priced into markets at all for the past 30 years. Since the fall of the Soviet Union, the United States has enjoyed unchallenged global dominance. We set the rules of international trade and finance. Our currency was the unquestioned reserve currency of the world. Our military guaranteed safe passage through international waters. Globalization flourished under our leadership, and American companies benefited enormously. That era is ending. China has risen to become a genuine rival. Their economy is now competitive with ours in size. Their military has modernized dramatically. Their technology sector has become world-class in many areas. They are not content to operate within the American-led order. They want to reshape that order to serve their interests. The United States and China are on a collision course. I am not predicting war, but I am saying that the relationship between the world's two largest economies is deteriorating rapidly. We have seen trade wars, technology bans, and increasing military tensions. Taiwan remains a potential flashpoint that could trigger the largest conflict since World War II. The rhetoric on both sides has become increasingly hostile. If the U.S. and China decouple economically, if we see the kind of sanctions and counter-sanctions that we have seen with Russia, but applied to China, the financial implications would be catastrophic. China is deeply integrated into global supply chains in a way that Russia never was. They manufacture most of the world's electronics. They process most of the world's rare earth minerals. They are a critical source of pharmaceuticals and industrial inputs. If those supply chains are disrupted, prices would spike dramatically. Companies with exposure to China would face massive losses. The entire architecture of globalization that has supported corporate profit margins for decades would unravel. Earnings expectations that assume continued global trade would prove wildly optimistic. Markets are pricing none of this. Companies continue to invest in China as if the relationship will continue forever. Investors continue to hold Chinese assets as if they are not at risk of being frozen or confiscated. Supply chains continue to run through China as if that concentration of risk is acceptable. The complacency is staggering. And it is not just China. Russia's invasion of Ukraine has demonstrated that major wars between large countries are still possible in the 21st century. We had convinced ourselves that great power conflict was a thing of the past, that economic integration made war unthinkable, that the nuclear deterrent ensured peace. Russia proved all of that wrong. The Middle East remains volatile. Israel and Iran could easily escalate into a broader regional war. Oil supplies could be disrupted. Energy prices could spike. The global economy that depends on cheap energy could face a serious shock. North Korea continues to develop nuclear weapons and the missiles to deliver them. They are increasingly erratic and desperate. A miscalculation could trigger a conflict that draws in the United States, China, and Japan. Any of these situations could escalate in ways that shock markets. And the market is not pricing significant probability of any of these risks materializing. The fifth danger is the loss of confidence in institutions. This is perhaps the most insidious danger because it is difficult to measure and impossible to predict, but it underlies everything else. Markets function on confidence. Confidence that the currency will hold its value, confidence that contracts will be enforced, confidence that the rules of the game will not change arbitrarily. When confidence erodes, financial systems can collapse very quickly. I am seeing cracks in confidence everywhere. Confidence in the Federal Reserve's ability to manage the economy without causing either runaway inflation or severe recession. Confidence in the government's ability to address the fiscal situation. Confidence in the stability of the banking system after the regional bank failures of 2023. Confidence in the political system's ability to function at all. The polarization of American politics has reached a point where basic governance is becoming difficult. We regularly flirt with government shutdowns. Debt ceiling debates threaten default. The peaceful transfer of power is no longer guaranteed. International allies are questioning whether America can be relied upon. When investors lose confidence in a country's institutions, they demand higher returns to compensate for the risk. Interest rates rise. The currency weakens. Capital flees. This can become a self-fulfilling prophecy where the loss of confidence itself causes the crisis that justifies the loss of confidence. We have seen this happen in emerging markets many times. The question is whether it can happen to the United States. Historically, the answer has been no because of the dollar's reserve currency status and the depth of our capital markets. But those advantages are not permanent. They can erode, and I see them eroding. Now, let me connect all of these dangers together, because that is where the real risk lies. Each of these factors is concerning on its own, but they are not independent. They interact and reinforce each other in ways that could produce outcomes far worse than any single factor would suggest. Consider a scenario. It does not have to happen exactly this way, but something like this is entirely plausible. A recession begins. It could be triggered by any number of things: a shock to the banking system, a collapse in commercial real estate, an escalation in geopolitical tensions. It does not matter what the trigger is. As the recession unfolds, tax revenues fall and spending rises. The deficit explodes to $4 or $5 trillion. The Treasury has to issue massive amounts of new debt. But who is going to buy it? Foreign central banks are already reducing their Treasury holdings. Domestic investors are losing confidence in the fiscal trajectory. Interest rates spike as buyers demand higher yields. The higher interest rates cause asset prices to fall. Stocks, bonds, real estate, everything. The algorithm starts selling. The passive funds see outflows. The derivative strategies automatically de-risk. The selling feeds on itself. Banks that are exposed to falling asset values face stress. Some fail, credit markets freeze. Businesses cannot refinance their debts. Layoffs accelerate. The recession deepens. The Fed tries to intervene. They cut rates. They restart quantitative easing. They provide liquidity to the banking system. But unlike in 2008 or 2020, their interventions cause a different problem: inflation. Because the underlying fiscal situation is so compromised, because confidence in institutions is so low, the money printing is not seen as temporary emergency measures. It is seen as monetization of government debt, as the beginning of a fiscal and monetary death spiral. The dollar weakens dramatically. Imported goods become much more expensive. Inflation rises even as the economy contracts. The Fed faces an impossible choice: fight inflation by raising rates and crash the economy, or fight recession by printing money and destroy the currency. This is what economists call stagflation, stagnant growth combined with high inflation. It is the worst possible outcome for investors because both stocks and bonds perform poorly simultaneously. There is nowhere to hide. I am not predicting this exact scenario will occur, but I am saying it is plausible, more plausible than at any other point in my career. And markets are not pricing any significant probability of such an outcome. That is what makes this the most dangerous market I have ever seen. Not just the individual risks, which are severe enough, but the interaction of those risks in a system that has become fragile through years of intervention and complacency. So what should investors do? How do you navigate a market this dangerous? These are the questions I ask myself every day, and I want to share with you the framework I am using for my own capital first. You need to accept that the traditional playbook may not work. The 60-40 portfolio of stocks and bonds that has served investors well for decades may fail in the coming environment. Both stocks and bonds could fall together if we get a stagflationary outcome. We saw a preview of this in 2022, when both stocks and bonds declined significantly in the same year. That was supposed to be impossible according to conventional portfolio theory. It was not impossible. And it could happen again. Worse, diversification across traditional asset classes may not provide the protection investors expect. When correlations go to 1, when everything falls together, diversification fails exactly when you need it most. Second, you need to own some real assets, gold, commodities, things that hold value when paper currencies are being debased. I have been accumulating gold precisely because it is the one asset that has no counterparty risk and that has held value through every currency crisis in history. It survived the fall of Rome. It survived the hyperinflation of Weimar Germany. It survived the collapse of Bretton Woods. It will survive whatever comes next. Commodities, more broadly, offer protection against inflation and supply disruptions. Energy, agriculture, industrial metals. These are tangible things that people need regardless of what financial markets do. They cannot be printed by central banks. They cannot be diluted by fiscal irresponsibility. Third, you need to reduce leverage. Leverage is what kills investors during crises. When prices fall, leverage amplifies your losses. If you have borrowed to invest and the market falls 30%, you might lose 60% or more of your equity. Margin calls force you to sell at the worst possible moment, locking in losses that might otherwise have been temporary. The investors who survive crises are the ones who can afford to wait them out. You cannot wait them out if you are leveraged. You cannot hold through the panic if you are getting margin calls. You cannot buy at the bottom if you have already been forced to sell. Fourth, you need to maintain liquidity. Cash is optionality. When crises hit, when asset prices collapse, having cash allows you to take advantage of opportunities. The investors who made the most money during 2008 were not the ones who held on through the crisis. They were the ones who had cash to deploy at the bottom. Fifth, you need to be geographically diversified. Do not keep all of your assets in one country, one currency, one political jurisdiction. If I am right about the risks facing the United States, you want some of your wealth outside the U.S., in different currencies, in different legal systems. This is not unpatriotic. It is prudent. Six, you need to think about what assets perform well in different scenarios. If I am wrong and we muddle through somehow, what assets do well? Probably traditional stocks and bonds. If I am right about inflation, what assets do well? Commodities, tips, certain equities with pricing power. If we get a deflationary crash, what assets do? Well, long-term treasuries, cash, possibly some defensive equities. You want exposure to assets that will protect you in multiple scenarios. Seventh, And this is perhaps most important, you need to be mentally prepared. Crises are as much psychological as they are financial. The investors who panic, who sell at the bottom, who make emotional decisions, they are the ones who suffer permanent losses. The investors who stay calm, who stick to their plan, who have the emotional fortitude to act rationally when others are panicking, they are the ones who survive and even prosper. I have been through enough crises to know that when they arrive, they feel worse than anything you could have imagined. The news is relentlessly negative. Your portfolio is down by amounts that seemed impossible. Everyone around you is panicking. Every instinct tells you to sell, to get out, to make the pain stop. You have to resist that instinct. You have to have conviction in your positioning. You have to trust that you prepared correctly and that the crisis will eventually end, because crises always end. Markets always recover eventually. The question is whether you are still standing when the recovery begins. Let me be clear about something. I could be wrong. I have been wrong before, and I will be wrong again. The market could continue higher for years before any of these risks materialize. Timing is impossible. The dangers I see could take years to play out, or they could emerge much faster than anyone expects. But that uncertainty does not change my assessment of the risk. The probability-weighted outcomes have rarely been worse in my career. The potential downside scenarios are more severe than anything I have seen, and the complacency in the market, the belief that central banks will always bail us out, the assumption that nothing truly bad can happen, that complacency makes the danger even greater. Because when the correction does come, when reality finally overwhelms the narrative, the shock will be enormous. Investors who thought they were safe will discover they were not. Assets that were supposed to be diversified will fall together. Strategies that worked for decades will fail. I take no pleasure in this analysis. I would much rather be bullish. I would much rather believe that the good times will continue forever. But my job, my responsibility to myself and to those who depend on my judgment is to see the world as it is, not as I wish it were. And what I see is the most dangerous market environment of my lifetime, a convergence of fiscal, monetary, structural, and geopolitical risks that has no historical precedent. A system that has become fragile through years of artificial support, and a market that is priced for perfection in a world that is anything but perfect. This is my warning to you. Take it seriously, prepare accordingly, and understand that the investors who survive and prosper in what is coming will be the ones who saw the risks clearly and positioned themselves correctly, not after the crisis began, but before. The ones who acted while others were still complacent. The time to prepare is now, not when the headlines are screaming, not when the panic has already started, not when the market has already fallen 30 or 40%. Now, while markets are calm, while you still have the luxury of being thoughtful rather than reactive, while you can make decisions based on analysis rather than fear, history rewards those who prepare for dangers that others ignore. It punishes those who assume that this time is different, that the risks everyone can see somehow will not materialize, that the authorities will always save us. This time is not different. The risks are real, and the reckoning is coming. I do not know exactly when, but I know it is coming, and I intend to be ready.